Hi, my name is Norm Miller. I'm a professor at the University of San Diego. I'm also affiliated with the Herman Hoyt Institute and Collateral Analytics. It's my pleasure to be with you today to talk about something we're all concerned about, the coronavirus or COVID-19, and what the impact is going to be on real estate. So no one can predict exactly how long the coronavirus will last or when effective vaccines will be rolled out. All we can do is speculate, but certainly logic and history based on SARS tells us a little bit about what we should expect both in the short run and the long run. There's going to be three immediate effects. One will be significant interruption of supply chains. No question about that. And that's obviously going to have some real estate implications. Secondly, significantly less travel and a fear of all crowded venues, and that's already started. So lots of cancellations of conferences and travel. And third, an overreaction in the capital market. We've already seen that affecting our stocks, our estimation of wealth. And fourth, possible government interventions to assist affected industries. And that started happening in China and in the US. So how's this going to affect real estate? Let's start with the most obvious. Hotel occupancy is going to drop along with conference center utilization. Tourist cities are going to be impacted more than other cities. Flights have been canceled, and as other travelers cancel flights, more flights are canceled, and so this can have a cascading effect. One of the beneficiaries of cancellations are going to be more use of video conferencing, like Zoom and GoToMeetings and so forth. And not only have we seen their stock prices go up, but they could be permanent beneficiaries because sometimes we realize that we could have held some of these meetings by video conference instead of in person anyway. Obviously, sporting events are going to be canceled, and that'll further dampen hotel occupancy. And how long is that going to last? Our guess would be 1 to 2 quarters based on the history of SARS and the peaking out of the coronavirus in China. With the supply chain interruptions, the most impacted property type are the big industrial warehouses, especially on the coastal cities and the port markets. They're already starting to be impacted. At the same time, because of an increase in e-commerce, the last mile smaller warehouse should be doing just fine to the extent that they have local supplies and local inventory servicing. There's going to be some things in the economy that we simply delay and other things that are gone and lost forever. The things that we simply delay are things like computer purchases and supply purchases for manufacturing. The things lost forever are the restaurants, the hotels, the fitness centers, the services, the entertainment, and that's simply going to lower our GDP almost immediately. In fact, our unemployment rate, which just bottomed out at 3.5%, is probably going to immediately start to increase starting in March and continue to increase perhaps for the next several months as we work through this. Work's going to be interrupted, especially if the child care centers close down and you can't take your kid to a child care center. And some people are already telecommuting. Now, what does that mean? In the short run, it means we're working at home, flexible schedules, getting together less. But if we learn how to manage people working at home better than we do now, that could be a permanent increase in the number of telecommuters. Right now, we're about 12% in the country. We could move as high as 15%. What does that mean for the office market? Well, the office market was already being affected by co-working and sharing. So the space per worker was already going down. This could bring it down even further. So the office vacancy rate could be impacted to the extent that we let people telecommute more than they do today in the future. The US economy is definitely going to be affected. It's possible that we're going to have a recession beginning late in the second quarter, possibly the third quarter. That will have reverberations on all the commercial real estate markets, but among those least affected would be multifamily. Multifamily works well because we need a place to live, whether we're in a recession or not. And in terms of multifamily adapting and being affected by the coronavirus, since more people will be trying to work at home part of the time, any kind of amenity that would facilitate working at home or in your apartment is going to be a big positive. So as we move to 5G and better Wi-Fi and internet connections, that's going to be a really great amenity for apartments or homeowners to have. There will be other kinds of effects as well in terms of amenities, but having a work, um, play environment, having a live work environment is a big amenity in the apartment market and the single family home market as well. Um, Retail property will be affected. We're going to have more e-commerce. We're going to have more e-commerce in one of the most resistant areas, and that is grocery shopping. Grocery shopping has not been very penetrated by e-commerce to date. There's a lot of people that like to go pick out their own produce and their own groceries. But with fears of the coronavirus, even unfounded fears perhaps, if we increase our use of online shopping for things like groceries and prepared foods, that's a positive for firms like Grubhub and DoorDash, but it's also a positive for the online grocers as well. And that might change our behavior permanently. So with the stock market crashing and the treasury rate seeing unbelievably low rates, under 1% as I talk, something like 0.75 or 0.8, what is this going to do to cap rates? Well, the spreads are going to increase. However, the treasuries are so low that overall cap rates might come down a little bit anyway. And I would expect that commercial real estate values are going to be the positive recipients of more capital allocations over the next few years, because if you look at what's happening to your stock market portfolios and the volatile up and down, you should be allocating more money to real estate, not less. So we should expect to see more money allocated to real estate, and even with higher spreads, cap rates might go up a little bit for the industrial warehousing, but it would be temporary if at all. For retail, a little bit, but they were already going up in retail because of the e-commerce trends. Maybe a little bit in office, and multifamily, I don't expect them to go up at all. But overall, real estate yields are going to be going down long term, especially with this capital reallocation from pension funds and institutional investors that should have allocated more to real estate before this. So in the short run, we have some things that are going to impact real estate, like hotels and ports, industrial warehousing. And in the long run, we may have some slight changes in the office market and the retail market. And obviously, e-commerce will only be increased by this, not decreased. Last mile warehouse demand will be just fine, but retail property could suffer a little bit with the coronavirus. Again, this is probably all an overreaction, but nevertheless, real estate is not going to escape effects of the coronavirus. So good luck to everybody, and thank you for listening.